Well, essentially, I think the fact that the property sales have turned lower, and we've seen that there has been some softening in overall infrastructure spend. What we've observed is that post this recovery that began, early this year, we started to see the investment line coming off a bit more faster, which wasn't really in our base case. And so, with that investment side downside, we thought we had to mark to market our forecast, and we've reduced it to 5% from 5.7. Having said that, we still do expect that there will be policy support coming in through. And our China economist is expecting three areas of policy support. Number one, we expect about R1 trillion of infrastructure capex, which would be packaged as green capex. Number two, relaxation of property purchases in tier one and tier two cities rather. And number three, some tax rebates for consumption items, particularly consumer durables. So we think that these three measures taken together will help the economy get back on track. But look, third quarter has already started, and we haven't yet seen these announcements come through. So we think that third quarter will also be somewhat weak, and we will see the recovery from the fourth quarter.
But I've got to ask you, Chetan, because you've got this, I suppose, almost growing expectation coming through from the people that are looking to invest in China right now on the equity side, and you just have to look at the latest both a fund manager survey across Asia to give you a little bit of a glimpse in that no one's really buying into the fact that you are going to see consumption coming on strong in China. And, there's a growing call that you need to have consumption vouchers, not tax rebates, but helicopter money. Do you think that there's any chance that the regulators or the authorities there are going to be like, okay, we really need to, in the short term, go big and hard on trying to juice up consumption just to get us through the next, perhaps, tumultuous 6 to 12 months?
Well, that's right. I think both from a structural and cyclical perspective, China needs to make this transition towards generating internal demand from consumption. However, I think, it is that policy philosophy approach that the government has had that they've never really given transfers. We've seen some little bit of transfers taking place in Hong Kong, but it's unlikely that we see that from the government in China. So most likely it will be tax rebates, and I don't think that we are going to see those transfers, which I agree would be the best solution right now. But I think considering the approach that the government has taken in the past, we are not building in that kind of a transfer to support consumption growth. However, if you do get investment side supported, i.e. you don't need to see massive stimulus, but at least not have a further deceleration on the investment growth, that will ensure that you have job creation, and then that kind of supports income growth and consumption growth. So it's a more organic driver to consumption growth coming in from jobs and income rather than transfers that's being built in our numbers.